This is Taking Stock on Bloomberg. I'm Pimm Fox. Now, cause for concern on the inflation front today. The Consumer Price Index increased 0.4%, led by the biggest increase in food costs in more than 2 years. So, which retail chains are best positioned to deal with these price increases? Can they pass along those increases to consumers? Well, here to identify some of the market hotspots is Laura Champine, retail analyst at Cowen Co. Laura is a Bloomberg best on the shares of Coach, Ross Stores, Big Lots, and others. Laura, good to have you with us on Bloomberg.
Thank you.
All right, so this idea that we're getting inflation, not just in food, not just in energy, but in apparel prices, something that we haven't seen for quite a long time, and this is going to, well, I imagine this has got to hurt the margins of many of the apparel retailers, no?
When we look at cotton prices, they've been deflationary on a real basis since 1976. The numbers that we have for apparel retailers show gross margins expanding for at least the last 15 years in a pretty steady pace. I think that record will be broken in 2011. Prices definitely moving higher, and the real question, as you mentioned, is elasticity of demand. How much will consumers take on price increases, and how much will these companies have to eat?
All right, now looking at your notes, one of the things I noticed was that there's a special kind of inventory that certain types of stores like TJX and Ross, that they actually buy now for this season, but they hold it until the same time next year because they want to be able to capitalize on that increase in price. They're going to be able to sell you things at today's prices when they expect inflation to take over. What's that inventory, and how does that even work?
Sure. This has been a little bit of an under-the-radar story. The company with the biggest impact from this is Ross Stores. It's called Packaway inventory. Basically,
Packaway inventory.
Sure. So they'll buy coats today and put them back in the stores next September. In doing this, they'll have great margins. It's grown as a percentage of Ross's inventories from about a third to nearly half. They're building an extra DC just to hold this product. So in the back half of the year, when full price retail sees margins under pressure, Ross Stores should see stable to expanding margins in the face of those cost increases.
All right, so if they're going to be able to take advantage of this and maintain their margins, what does this do to the makers of the apparel? Because it seems as though there are certain dynamics within the industry, no returns, no promotional spend, that the manufacturers really like about selling a lot of their inventory to Ross Stores.
Ross and TJ Maxx being growing parts of what wholesalers do is not the best news for them, but it does give them an outlet, at least for the true closeout, for product that has no other home. Now, I think when a company is as large as TJ Maxx and carries the consistency in brands that TJ Maxx has, that some of that goods is actually made for them, and that's really not what those manufacturing plants want to be doing. But at this point, they just want to gen out units. That's the real concern for the wholesalers.
They just want to keep the lights on and keep the production line open.
It's an incremental cost business, and it'll be a real issue in the back half of this year, more for the suppliers than for the retailers, because most retailers, we think, are planning units down this year. They're
going to plan units down because they don't think that they're going to be able to pass along the price increases, or because they just don't think that the sales are going to be there?
With the economy under pressure from so many different areas and having to raise prices, I think they will need to plan units down. And we're hearing from some retailers as much as down double digits. So those manufacturers, to keep their plants running, they really need TJ Maxx and Ross this year in a way that they probably haven't for a long time.
So are you suggesting that investors take some profits from companies that are not TJ Maxx, TJX, as well as not Ross Stores, take some of the profits and put them into these kinds of companies?
I think it makes sense to hide away from full price retail, particularly retailers that don't have pricing power. I think the teen apparel space is one area that doesn't have a ton of pricing power. I'd take my money out of those shares and put it into the closeout retailers now.
Tell me about Whirlpool, because, okay, even if you're not going to buy as many clothes as you want, you're still going to wash them. But Whirlpool's numbers, not that great recently. We've had a bit of a problem there, a lot having to do with cost inputs, mainly steel.
Sure. So inflation hurts every company that we follow. Whirlpool's a little closer to it with steel. Steel costs also up substantially year on year. This is a company that has absorbed, we're looking at nearly $3 billion in raw material inflation over the last few years, another $300 million this year. So that should pressure margins. The entire appliance industry is trying to pass through a major price increase, 8 to 10% in early April. Probably at least some portion of that will definitely go through, in our view, just because it's obvious they need those increases.
So buy your washer or your dryer now. Don't wait to April when at least there's going to be a small incremental increase in the price of these appliances.
We wouldn't wait.
You wouldn't wait. What about the shares of Whirlpool? Would you wait on those?
Whirlpool has an interesting period ahead of them where they're lapping the stimulus on energy-efficient appliances. I think, though, that investors will look through that as we move through. So it's not an urgent buy at this moment. Maybe let them get Q1 out of the way. But I think Whirlpool has a ton of upside potential, very cheap on a cash flow basis for a longer-term investor.
All right. In the meantime, TJX and Ross stores.
That's
all right. I want to thank you very much, Laura Champine, coming to us from Cowen and Company.